with us to talk about Groupon is Paul Kedrosky, respected tech observer and author of the blog Infectious Greed. And Paul, first of all, the first line of the Wall Street Journal story on this deal read, "Bubble-like tech companies unite." What's your take on this agreement?
Yeah, so it's natural for them. I'll say that there's an obvious symmetry between these two companies. You got one company who's trying to push the Groupon trying to push this Groupon Now, instant couponing tied to locations, and you have Foursquare, who has rightly been struggling, trying to find some way to make money from people checking into locations. And so they tied up with Living Social and they've tied up with others. So there was a certain inevitability to this. The only thing that was surprising was it took as long as it did, and as it turns out, I'm speculating, but I think others have been speculating the same thing, that there are technical reasons why Groupon didn't come to a deal back when Living Social did with Foursquare. So, this was about as obvious as things get in the tech world.
Now, we've been looking at the SEC investigation into Groupon's S-1 filing. Of course, very curious to hear your take on this metric that Groupon seems to have invented, CSOI. We were speaking with a former SEC lawyer yesterday who said this must be giving the SEC digestive problems. What do you think about all this?
Yeah, this is back to this whole discussion of what my friend Bill Gurley at Benchmark likes to call proxy valuations. This idea that in certain circumstances it makes sense to use things other than revenue and earnings, or at least straight up revenue and earnings to value companies. The trouble is when you start getting really far away from that, and CSOI excludes enough material items from Groupon's earnings that it is really far afield that you lose comparability. How do I compare $1 of Groupon's earnings post CSOI with $1 of, say, LinkedIn earnings? It's really very difficult to do that. So this sort of, almost abstract art as pro forma accounting it makes it impossible for investors to do any kind of comparability. And then in the limit, it becomes silly because you start to say, well, why not just have earnings before expenses? Why stop here?
And we do have a graph actually comparing the number that Groupon wants you to look at in terms of its costs and the usual way to evaluate that number, Paul. There's been a huge debate about Groupon in the investment community. You have been, more negative on it. Others have been more positive. Is any of this impacting Groupon's valuation or the opinion among investors about Groupon's viability?
Oh, I think there's a lot of nervousness in the institutional investor community about Groupon, not in terms of viability straight up. It's not like people are saying, this thing's going to disappear before it gets a chance to go public. But it is an open question at what valuation it comes public. There's a lot more skepticism in the institutional investor community, who are the natural buyers of this IPO, than there is in the retail community, who just digs getting stuff for half off. And that's a lovely thing, but it doesn't translate into a great business. So we have this problem straight in the face.
All right, Paul, we'll have to leave it there. Always great to have you here on Bloomberg West. Sure. Paul Kedrosky, author of the blog Infectious Greed. Thank you so much for joining us.